Hello and welcome to the next installment of the Knightsbridge Trading Academy 10-part video series on the aspects of trading the foreign exchange market. In this video presentation, we're going to look at the very important subject of risk management and how to place a trade. What we're going to do first is go through the theory, then switch to MT4 and FX Compass to look at some forex strategies and apply risk management to a trade. So within risk management, one thing we want you to remember before even placing a single trade is to risk manage every single trade. And for this, we need to focus on protecting the downside and let the upside take care of itself. These words literally need to be a part of your trading philosophy, and you need to ask yourself before each trade, is this trade correctly risk managed? If the answer is no, you don't take the trade, period. Always pay attention to the level of risk you are taking with each trade, otherwise the cost of getting this wrong is high. It is the number one reason that traders in the forex market lose their entire balance. In trading, there are only 4 possible outcomes with each trade. That is, you either make big gains, small losses, and big losses. And the only one of those outcomes we really don't want is the big losses. The rest are fine. Even with the small losses, we live to fight another day. And as you will realize with trading, it's not going to be possible to predict the right side of the market each and every time. All we can do is stack the probabilities in our favor by analyzing price action correctly, using technical tools, and an understanding of the macroeconomic environment as a collective to give us clues as to where the market is most likely to head. But nothing is ever guaranteed, as markets can change within an instant. So as nothing is ever guaranteed, you most certainly don't want to leave yourself open to big losses, as those losses not only limit your ability to take another position financially, it leaves you with an even more detrimental effect on your mindset and your psychology. And this, ladies and gentlemen, is far worse. You may not believe it yet, but having a clear and strong mindset to think logically about each and every trade you place is half the battle. If you take a big loss, there's a strong chance of you getting your egos and your emotions involved, and that's dangerous. As emotions run high, you have a greater chance of taking trades irrationally, chasing the market even though the market has told you it's changed, and this can lead to ever more losses and a worsening mindset. Or the losses could be big enough that you completely lose your confidence to trade, and you end up missing out on the big profit trades as you are too nervous to take a position that you analyze correctly. But due to your loss of confidence, you hesitate and miss the opportunity completely. You are essentially left paralyzed, and most people think this won't happen to them, but it happens countless numbers of times in the market to those who forget the risk management is an imperative part of your success as a trader. One of the main ways we can protect ourselves from big losses is to attach a stop loss order to every trade we place. A stop loss is there to limit our loss and preserve our capital. We will learn how to apply stop losses in MT4 a little later. But first, let's dip into the subject of risk management a little more. So before we attach a stop loss order to a trade, it's important to understand how much capital we can afford to risk per trade. And there are only 2 main rules for this, which aren't negotiable, and breaking them puts you in the category of the 95% of losing traders out there. So, rule 1, do not risk more than 1 or 2% of your total equity on a single trade. So if I had a £10,000 trading account, 1% of the account is £100, meaning the maximum I can risk losing per trade is £100. And 2, rule 2, your expected return for the risk must be at least 2% of your equity if you have a 1% risk on that trade. In other words, expected return must be at least double that of your risk, or as a ratio, for every 1 part of risk, we need to aim for at least 2-part return, and ideally 3 times the return. So in the example of the £10,000 equity account, we need to have a high probability trade that shows for £100 we risk, we can make a potential £200 as a minimum. A high probability trade takes into account the price action, technical analysis concepts, and the macroeconomic environment, making sure an estimation that the market has a strong potential to move in a particular direction that will allow us to risk maximum 1% for an expected minimum return of 2% on our capital. So if you make your focus on protecting the downside and look at each trade as a process whereby you have all relevant tools, so technical and fundamental, that indicate that the market is likely to head in a certain direction, but with the attitude that if you take the trade, it can only be a small loss which risks no more than 1 or 2%, then that's the correct way to approach each trading idea. It's about the quality of our trades and not the quantity. So if your trading ideas risk more than 1 or 2% and or the expected return is not at least double the expected risk, then do not take the trade. I can't emphasize that enough. So what I've done is I've created a spreadsheet simulating 20 trades with varying numbers of winning trades and varying numbers of losing trades. And we can see how the principle actually works in your favor. Okay, so this spreadsheet I've drawn up gives us a deeper insight into why risk management is key and why the risk-reward ratios work. I've kept it quite linear in terms of the amount risked each time, even though in practice, if my account balance increases or decreases from trading, the amount I can risk would change each time. But I kept it simple to make it easier to explain. In this example, I have a £10,000 trading account. I only risk 1% of the capital on a trade, and my target return I aim for on each trade is 2%. In other words, I risk £100 for an expected return of £200 minimum. And in each row of the table is the simulation of 20 trades. The column on the far left shows the number of trades that hit my stop loss and the number of trades that hit my take profit from a total of 20 trades. You will notice from the first row of the table, it shows if all 20 trades I take hit their take profit and no trade is stopped out, I would earn a maximum of £4,000. And the very last row shows if I do 20 trades and every single trade I take hits the stop loss, I lose £2,000. So already we can see that even if things go dreadfully wrong and all 20 trades hit stop losses, we would lose 2k, but still have £8,000 in the account balance remaining, which is enough to make a comeback from. However, what's most interesting is how many trades I can afford to get wrong before I turn a profit. And if you look at the blue arrow on the Excel spreadsheet, it shows I can afford 13 of my 20 trades, which is the majority, to hit their stop loss, and I still turn a profit. And that's great news. And the news gets better if you seek out higher reward ratios to risk. The other bonus that comes with taking small risk with at least twice the expected upside return is that you are going to be less nervous when you have a live position on than if you had a position where 20% of your equity was on the line. This composure is important as you are less likely to make irrational decisions which can occur with larger risk positions. Obviously, for the reason they have larger amounts to lose. So not only do you risk less with a smaller percentage risk, you also have better composure, you're less emotional, and you're less likely to make hasty decisions. So you have a win-win situation, and that's exactly what we want. So now that we understand what percentage of our capital we can risk per trade, what's next? And the next step is where we merge the maximum risk amount we can take per trade with a stop loss in order to calculate how big of a position we can trade to stay within our risk limit. So first, we need to have an entry price and a stop loss chosen. Once we know this, we then need to calculate the pip difference between the entry price and the stop loss. And depending on if you are taking a long position or a short position, the maths is a little different, but very simple. So if you buy or go long, it's entry price minus stop loss. And if you're selling or going short, it's stop loss minus entry price. So let's say from the analysis of price action, the use of technical analysis tools, and the understanding of the macroeconomic environment, we have an expectation that euro-dollar will head higher, and we have identified a trade with a stop loss and an expected profit target that is at least twice that of the risk. So if we stick to the example of a £10,000 trading account and the max risk per position is 1%, we have £100 we can risk on a single trade. So long as the expected return is 2% of equity at £200. So we want to go long euro-dollar at 1.7100, which is our entry price. And the most appropriate stop loss we have identified is at 1.7000. The difference between the entry and the stop loss is 100 pips. Now some of you may be a little bit confused by the term pip, which I will illustrate as it is important for you to understand, and once we do, we can come back to finish off the position size calculation. So what is a pip in Forex? A pip is a unit of measurement that represents the change in value between a currency pair. So if euro-dollar moves from 1.7000 to 1.7001, that is mathematically a 0.0001 dollarize in value, which represents 1 pip. And again, it's a 100 pip move if it goes from 1.7000 to 1.7100. A pip usually goes out to 4 decimal places. Most currencies like this, which include sterling dollar, dollar CAD, Aussie dollar, dollar Swiss, etc., etc. However, there are the odd exception, and that be the Japanese yen, which goes out to 2 decimal places. So a pip in dollar yen goes out only 2 places. Now on the right, I wanted to point out that there are brokers that quote currency pairs beyond the standard 4 and 2 decimal places and quote to 5 and 3 decimal places. These are fractional pips called pipettes. As you can see from the screenshot of my MetaTrader platform on the right, the quotes go out to 5 decimal places. And as you can also see, dollar yen, the pip goes out to 2 pip decimals, followed by the pipette as the 3rd decimal. So hopefully that's put a little bit of light on what a pip is. But before we move on, the final thing worth understanding about a pip is that the value of a pip is dependent on the counter currency. So in the example of euro-dollar, the counter currency is dollars. Or if we think dollar yen, then the counter currency is yen. So if we take the dollar yen example, and it goes from 114.50 to 114.55, it's increased in value by 0.05 yen. Notice it's yen, not dollars or sterling. And this is important to understand, as when we go back to finish off the trade position size, we may need to do a further calculation to calculate how much risk that is if our account balance is not in yen. But the good news is you do not need to worry, as there are online calculators that do most of the work for us. So coming back now, if you remember, before we left to talk about what a pip is, we had calculated in a trade example that the difference between our stop and our entry was 100 pips. So now, to keep things as simple as possible, we can use the online position size calculator to work out the max position size we can trade to stay within our risk limit using the example we've spoken about earlier. So this is the babypips.com website, and on this site there are a number of useful tools we can use to aid us in our foreign exchange trading. One particular example of this is the position size calculator, and with a few values we can find out the maximum position size we can take according to our risk parameters. So I'm just going to scroll down here and look at, there we are. So if you remember from our example, we had a £10,000 sterling account. So few things we can change is that to sterling, the account balance to 10,000, the risk percentage was 1, the stop loss from my entry was 100 pips away, and the currency pair we were trading was euro dollar. The next column is the price for sterling dollar, which is 1.2325. The reason this is important is in the example we are trading euro dollar. So as pip values are based on the counter currency, which is dollars in this example, and our money is held in sterling, we need to convert dollar amounts into pounds to get an accurate pound level risk. So once we've entered those parameters, we can simply get calculator, and it tells us what's the maximum position size and the amount at risk we have. So £100, which is what we wanted most. The position size shows us that we need to trade 12,325 units in order to stay within our risk limits according to where our stop loss is. Now, it's got a few other metrics down below, like standard lots. A standard lot is 100,000 units, a mini lot is 10,000, and a micro lot is 1,000 units. So the exact amount we need to trade is 12,325, but if you can't do that and the broker's only offering you, say, 10,000, then you can do a mini lot, and if you can do micro lots, then you can do 12. So in summary, if we buy euro dollar at 1.7100 with a stop at 1.7000, 100 pips, and we buy 12,325 units exactly, we know that we have taken the correct 1% risk for the trade. And so if we do lose in that position, we're only losing £100, and that means we are correctly risk managed. So just to summarize all of what we've just learned, first things we do is we want to calculate what the maximum risk is that we can take per trade. So what we do is we calculate what maximum 2% of our equity capital is, and that notional figure is the maximum we can risk. Once you work that out, you could then go and identify a trading opportunity using and combining various market methodologies such as technical analysis or fundamental analysis, looking at the economy and having your view. The next is, once you have identified that and you found the stop loss and an entry and a take profit, then you must work out, is the risk to reward ratio, if you will, good. So you need, if for 1% risk or 1% of your equity risk, you're looking for at least 2% on your equity in terms of return. Whereas, as we said earlier, as a ratio, 1 to 2 as a minimum. Ideally, we should be looking 1 to 3. So let's say we found that. The next thing we do is work out the difference between our stop loss and our entry, and that will give us a certain pip amount. And then we just plug that value into the calculator that I showed you on baby pips to work out what the maximum position size we can trade in order to stay within our limit. Next thing we're going to do is look at FX Compass to find a trading strategy and then execute it using MetaTrader. What we have here is FX Compass. FX Compass is Knightsbridge Trading Academy's innovative technical research tool, where research is provided by our team of technical analysts and economists. The research is consistently updated to help you stay ahead of the market. Inside the portal, what you would see is a list of currency pairs which are continually analyzed, as well as 2 commodities. And the way it's done is you have the chart with a technical indicator and various bits of analysis, and a list of key support and resistance levels, which are also listed here too. Support and resistance levels are important if you're setting stop losses and take profit targets, and even entry can also be looked at. So the way it's set up is you have a short-term view where the economists and the technical analysts expect the market to go. A strategy, so generally it's a entry price, a stop loss, and the take profit. So in this example, the strategy, they have no real view and they're sidelined, so there is no clear direction, if you will. And if you go a little lower, then we look at the short-term view, what they expect for euro-dollar, which they expect it to go higher, and the medium term to go lower. So if we go to the tabs on the right, we have the short-term view, we have of euro-dollar, we have a medium-term view of euro-dollar, we have a trader's view, and economic data releases from the euro and the US area. So one chart I was looking at, also one bit of analysis I was looking at a little earlier, was the Aussie dollar. Okay, now here what we're going to do is we're going to simply apply the stop loss, the target, and the entry levels. Now, as you may have already seen, the market's slightly moved away from the prices given here, but we're using it as an example's sake and applying it to MT4 to take the trade. So if we choose to buy at spot 7374 and to have a target of 0.7629, that gives us a reward of around 255 pips. Now, the recommendation here is as a stop under the spot 312. So in this case, I'm just going to choose the next support level that lies below it, which is the spot 7289. And using that gives us around 85 pip risk, which the risk and the reward, the difference between them, is around 3 times as much, which is good, which is kind of what we're looking for before we place a trade. So I'm going to switch to MT4 and just put this strategy into an order. So now that we've identified a entry, a stop, and a target, and taken into the principles of risk management, we can learn to place a trade using the MT4 platform. But before we do that, we need to work out the maximum position size we can take to stay within our 1% max risk limit. So what I'm going to do is quickly switch to the FX position calculator and then work them values out. So in the position size calculator window, we just enter the variables we already know. So we know our account is in sterling, as we can see in the balance. Our account balance in this case is 99732. Our risk percentage is 1%. Our stop loss in pips, which we calculated earlier, was 85 pips. The currency pair we're trading is Aussie dollar. And now we need a price for sterling dollar. And the price for sterling dollar is 1.2378. Once we've done that, we click the calculate. And this is telling us how much risk we risk. So we're risking £997.32, which is within our 1% risk. The position size we need to trade so that we stay within that if our stop loss gets hit. So it's 145,223 units, or one standard lot, or 14 mini lots, and 145 micro lots. So let's enter these numbers into an order. So go into the new order, left click on the mouse, and that brings up the order window. And now we have all the information to place the trade. We can go ahead and do that. So the volume, if you remember, we calculated to only be one standard lot. The stop loss was 0.7289. The take profit was 0.7629. So let's plug those numbers in. So we have our stop loss, our take profit, now the type of execution we'll be doing is a pending order, and the price we'll be trading at was the entry, which was 0.7374. And once we're ready with that, we simply click place trade, and you will see a dash lines. The green is going to be our entry, and you can see the buy limit, the stop loss SL, and the take profit red line here as well. Now those figures will be reflected in our terminal window. If we go down, we can see that. So the buy limit, price that we want to trade at, the stop loss, the take profit, the price is currently trading at, and obviously we haven't entered, so there is no profit or loss at the moment. And that's how we apply the trade using risk management principles. So that concludes the very important subject of risk management. The principles of risk management are key to your trading success, and we hope that this video has provided you some value. We wish you all the best from the Knightsbridge Trading Academy team.